Bismillahirrahmanirrahim. This is your lecture number 7. This is about the bond markets. In the previous classes, we talked about the money market. The money market is the market for short-term instruments, and we discussed, like there are many firms, even very big firms, actually keep billions of dollars of their assets in the form of money market instruments. The reason is like, they create their portfolios, and these portfolios include everything, some assets of short maturity and some assets of long maturity. The assets of short maturity basically are traded in the money market, and assets which actually are having longer maturity are not traded in money market, rather they are traded in the bond market. So we are going to talk about another very like naturally sequenced market which we needed to understand after the money market. In the last class when we were having this class in the university, we were talking about that how the money market works and what kind of money markets exist in Pakistan, what kind of different instruments basically are used and actually are just traded in the money market. So that money market has got its own significance because of the availability of liquidity and short termness of the instruments. Many institutional investors like to trade in the money market because of the the available liquidity whenever they require it. So the bond market also exists simultaneously because sometimes the corporations and the governments need to borrow and lend money for short term, but they equally sometimes want actually these transactions to be a longer term to finance the longer term projects. Like say for example, if you are planning to go for an investment that basically has got a life of 10 years, 15 years, 20 years, you need some financing that basically lasts for that many years, and you are not basically obliged to pay just in the middle of that particular kind of investment. So the governments generally issue a lot of bonds as well, so as corporations and other kind of the private companies, they also basically have got some short-term needs and some long-term needs. To cater the short-term needs, they they go into the money market, but to cater the longer-term needs, longer term in the sense like they want when they want to have longer term borrowing and lending, because the longer term borrowing is always in the interest of the corporations and the governments. Because if you are actually planning to go for a longer project, a period, actually a project of a longer duration, like say for example you are building some kind of a plant, and that plant needs to take say for example next 5 years for the development, you need to borrow money for that 5 years. So you don't need to basically you won't don't want to return that money in the middle because that is under the construction during that time. So you basically you just try to borrow for the longer term. For that particular kind of a situations, you have got instruments, and you basically trade in the bond market. Now if you look at the definition of bond market, what is the bond market? A bond is borrowing arrangements through which the borrower or seller of a bond issues or sells an IOU document. IOU is an acronym, and it perhaps is self kind of words that basically are just also having the same meanings. IOU. IOU means I am owing something to you. Okay. So this is the document that is called IOU document. IOU again means that I am owing you amount. That is something, it's an acronym and itself saying the words that I owe you the documents to the investors or buyer of the bonds. These bonds are the debt securities with fixed income. Like when you make investments into the financial markets, generally these investments are either say for example, the equity investments or debt is invest that transactions. The bond basically is related to the debt securities. When you make or when you actually create a link or financial link with a company, either you join that financial link through investment or through borrowing or lending. So this is the borrowing and lending that creates debts. Like either you give debt or you take debt. That means loan. Okay. So the bonds are debt securities with fixed incomes. Of course, if you think about equity, equity has got variable income. Sometimes you have got more income, sometimes you have got less income. Sometimes companies announce higher dividends, sometimes companies announce low dividends, sometimes companies people get capital gains on their shares, sometimes they get capital losses on their shares. but the debt instruments basically have got fixed stream of income. Like say, for example, if you actually invest in a bond, you may be getting a particular interest rate, like amount at a rate particular, like decided in advance when you bought this bond or you just invested in that bond. Okay, so the bond again is a borrowing arrangement which different people do. Like say, for example, a company wants to borrow money, they issue a bond. Bond is a kind of an instrument, it is a kind of a receipt, it is a kind of a document that the company gives to you in return of the money that you lends that money to the company. So that as a kind of a document that shows your, like the amount that company owes to you, and that basically provides you the other details we are talking about. Now, if you try to understand the bond basically is a type of investment where you as an investor lend money. You are lending money, you are not investing money. When you invest money, you buy an equity instrument, you buy shares, you buy any other kind of the instruments. But like when you lend money, you buy a bond. And to whom you lend this money? You lend money to the government or a company. Like, of course, these are the two kinds of lending that you do. Like either you lend to the private companies, or you lend to the government in exchange of the periodic interest payments. Why do you lend? Why are you going to lend this money? Why are you going to sacrifice your use of money? Like say, for example, when you lend your money, it means that you shift your money from your pocket to another people, like and that basically is the time when you are not able to use your money. What is the consideration for you when you actually transfer this, and you basically just give that money to some company, the periodic interest payments, and at the end of the day, you get the principal back. So this is a type of investments that you are making, but that is an investment in which you make lending. Okay, investment, not exactly the investment sense. It is the investment in through which you lend, and this lending happens. Why do you lend this money? Because you want to get certain return every month, every quarter, or every semi-annually or annually, or like whatever is the arrangement that you have. Like say, for example, many widows, many retired people, many kind of like people who do not have got time to make active investments, they buy long-term instruments which actually give them some kind of regular stream of income. Like say, for example, even if you are not capable of doing business, still like you are doing job, but still yeah, you don't want to do into business, you don't want to go into business, you may buy a bond, and that bond can pay you a longer term equal amount of like amount of invest, like in money, that is something is available. Further, the bonds are considered fixed income securities. As you know that when you buy a bond, you actually go into the contract in which you lend money, and you get a promise to get an equal amount or some fixed amount of income every kind of a period. That period may be month, quarter, or 6 months or 1 year, or depending on the nature of the bonds. It is essentially a loan that you give, that provide to the issuer, and the issuer who issues that bond loans, basically like issuing loans means issuing bonds. A company is bringing and issuing bonds, and what actually these bonds are getting them, they are getting them money. And what are they going to return against them? The money again. And that money actually will be in the form of interest on the money which they have borrowed from the people. They are a way of governments and companies to raise funds and for investors to earn income while preserving their initial investments. So they are a very important way for the governments and companies to raise funds. Like, of course, every government or a company requires money when they lead some project, when they go into certain kind of a project, they basically need money. And how do they get money from the people? They issue them a promissory note, and that promissory note is a kind of a bond. That bond is something that basically shows the promise and amount that basically the company has taken the loan, and they are going to return you with this kind of interest, and they are going to return your principal amount after a certain point of time, and that certain point of time will be the time of the maturity period of your bond. Now, what is the importance of bond? Like why the bonds are issued, why this bond market exists, and why, like you have got this very active bond market all over the world actually placed. The very first function, or the, like the work that the bond market does, is the credit allocation. Like there are a mismatch between the people. Like, say for example, there are some people who want to lend and there are some people who want to borrow, but of course they don't know each other. As, say for example, if you want to rent a house, you are looking for a house. You, as a person who wants to rent a house, you are looking for a house as a tenant, and there is some person, like living in your society, who wants to give, or who wants to basically give his house on rent, but you don't know each other. You are not aware that who is willing to lend their houses, like on the rent. And the person who wants to rent his house doesn't know that who basically wants to take the house on rent, and how credible or uncredible the person is. For that, you have got certain kind of, like markets available, like the real estate markets or the real estate agents, which actually matches the demand of the tenants with the demand for the landlords, and somehow this transaction takes place. Something similar the bond market does. Like the people basically who have got extra money, they basically like want to lend, and there are some companies and the governments who want to borrow money. If, like they somehow get a place where they come together and they exchange, or they basically make the transaction, and this transaction is, in this transaction, one particular party is interested in lending money and another party is actually borrowing money. So that particular bond market provides you the avenue or the place where you can do this. Similarly, it provides you the funding for the government and corporations. The governments and corporations always need money, extra money. Like, as you remember, we were talking about, the governments generally run deficits. These deficits means that the government's expenditures are generally more than their revenues. To bridge the gap between the revenue and expenditures, they issue bonds, and these bonds bring them loans. And these loans basically are there to help them bridge the gap between their income and expenditures. So this particular market provides funding for the government and corporations, equally the corporations as well. Like there are some public borrowing in public lending, and there are some private borrowing in private lending. The private borrowing is made by corporations, and private lending is of course made by the private households. So this is the a kind of an arrangement that happens, but which actually market facilitates this. The bond market is there to facilitate this, and it provides you the investment opportunities. Of course, like if you want to have, if you want to make investments, you look for certain products in the bond market, and you may make investments, and you can earn profits on the basis of your requirement. Like, say for example, some people need monthly money, some people need quarterly, semi-annually, or annually. And what kind of money you require, what kind of investment you want to make, that basically is something, is the chance that you get, as an investment opportunity in the bond market. The bond market also provides you the risk diversification. Of course, this is the, a kind of function that every such financial market performs. Risk diversification means, of course, it provides you different kinds of products in which you can divide your investments, and this division of the investments create this division of investments creates, like a different kind of, instruments for you. And if some instruments lose some money, some other instruments basically help you gain it. Like, say for example, again, of course, this bond market is a market where your returns are fixed, so you may basically average out your return from your equity market with this kind of a market's investments. And also, like these bond markets provide the interest rate benchmark. If you remember, in the beginning of the classes, we were talking about the interest rate determination, and how did we, we determine the interest rate. The first tool of determining the interest rate is through the bond market. We look at the demand and supply of the bond market, and we somehow find out the price of the equilibrium price of the bond, and that equilibrium price is plugged in into the interest rate formula, and we find out the equilibrium interest rates. So that is what something the bond market does. It also provides you the interest rate benchmark. The interest rate, the basic interest rate, is determined into the bond market. So understanding the legal aspects, this is a kind of a future contract that you are making with the people. Like, say, for example, I am lending money to a corporation or to the government. There are a lot of legal things basically involved into this. Legality basically involves, like, say, for example, what happens in the event of default. Like, say, for example, if the company I lent money to just go out of the business, it doesn't pay you back, it doesn't pay me back the money which I have lent to this company or the government. Like sometimes, as we are aware, that recently even the governments, basically different governments, defaulted on their payments. Like, say, for example, Sri Lanka, as you must have got the examples in your mind, that Sri Lanka recently has got a very bad example of defaulting on their sovereign loans. The governments borrowed money from the people, and at the time of the interest payments, the government told to them that we don't have money to pay you back. So it is a very, like, a kind of a very dirty situation. It's a very dirty and a bad situation a lender can come into, because, like, say, for example, you have just given your whole life's assets to somebody, and the somebody is telling you that I don't have money to pay you back, or I am not able to pay you even the interest on the money that you have lent to me. That is a very, very kind of a, like, nasty situation you may get into. For that, you need legal cover. All right. So there are a lot of legalities involved into this. Whenever whenever you go into this kind of a contract, you always actually do these contracts under the legal framework. So whenever you write a contract, because writing a financial contract always is a tricky, because like the returns on the financial products depend on a lot of factors. It depends on a lot of conditions. It depends on your economic situations of the country. There are a lot of things that basically it depends on. So the legal framework is often detailed in a document called the bond indenture. Like when you just borrow or lend money through the bond, there is a structure called bond indenture. Okay, this word indenture actually governs the relationship between the entity issuing the bond and the bondholders. Like, what kind of relationship you have got, how much is the responsibility of the person who is issuing the bond, and what is the responsibility of the person who is taking the bond. And similarly, like the basically, like, is just like buying the bond, and what kind of rights and duties basically both people have. So this is what something this bond indenture explains. Now, if you look at the functions of the bond indentures, obviously the objective of this indenture is to protect investors' rights. It outlines the rights and obligations of the bondholders. Like, say, for example, what are your rights in the event of default? What you can do? Like, say, for example, sometimes when you go to borrow money from the bank, you mortgage your houses. Now, in that particular kind of a legal indenture, what you basically promise to the bank, that you promise, or you just give them the authority, that in the event of default, or in the event of like not paying money, the bank has got the right to sell off your property. Something similar happens when you buy a bond, and you basically have got the legal rights. What kind of legal rights do you have? This bond indenture also provides you risk assessments. So what are the risks associated with the investments? Like, if you are, like, say, for example, when you read the legal terms and conditions, like, say, for example, sometimes when you are installing a software on your computers, they actually ask you to agree with the terms and conditions. Okay, sometimes we don't read them, and that basically may be very damaging, because like sometimes there are a lot of conditions in that particular kind of an agreement that may go against you, or that may go in favor of you. So if you are not aware of them, you cannot get the advantage, and you cannot protect yourself from something something bad happening with you. So it also creates a kind of accountability of the issuer. If the person who is issuing the bond, be it is a government or any corporation, if it fails to meet its obligations, like, say, for example, they are not paying you interest, they are not returning your principal amount, they are not basically, meeting the actually the promises that they have made when they were actually borrowing money from you. So that actually creates an accountability of them as well. Failure to meet obligations can result in legal consequences. Understanding these legal responsibilities help issuers maintain credibility in the financial market. So if you are aware of it, you basically should know that this is something that you are going to face if you are not paying money to the people like you have borrowed from. So this legal indenture is a very important, and you being a person who borrows or lends money through the bond should be able to understand the legality of those instruments, what kind of responsibilities you have, and what kind of responsibilities the issuer of the bond has, what kind of duties you have, and what kind of duties that particular person has. So you basically, like, or the company has. In if you know that, like, there is a very little chance that you will be having losses, because like in times of uh, problem, this legal indenture basically provides you cover. Like, say, for example, if the company that has borrowed money from you is not able to pay you money or is not willing to pay you money, you can sue them, you can take them to the court, and you can basically sell some of the assets which they have promised to sell if they basically in the event of default. Now, how do you know that the bond is a good bond or a bad bond? Okay, like, say, for example, if you are just trying to invest in a bond, how are you going to be knowing, that this bond is good or bad or not good or not bad? So it is something very tricky kind of a situation. Like, you cannot, being an individual investor, have not very much ability to judge or to understand that, like, what kind of risks you are going to take when you are buying a certain kind of a bond. Like, say, for example, when you buy a bond of the government, you basically have got a safety in your mind that you perhaps are not going to have face a default on your payments, because the government is, of course, responsible for its payments. But technically, you need to know basically that the credibility of the corporations when you just make them lending. Okay, when you buy a bond of a company, how do you know that this company is a good or bad company? Okay, so one way of looking at the credibility of that country is to look at what kind of ratings they have. So there is a bond rating available. The bond ratings, what actually it does, like, what does the bond rating do? The bond ratings provide you valuable insights into the credit worthiness of the bond issuers. It tells you that how credit worthy, how reliable, how, credible the person is, that is issuing the bond, person or a company or a government, whatever. Something sometimes, like, of course, sometimes, you have also have got the ratings available of the governments. Like, say, for example, being in a very, precarious condition in Pakistan politically and economically, Pakistan's bonds ratings are not very good. Like, if you are an international investor and if you want to buy any bond from Pakistan, the Pakistani government, they actually don't rate them very good because of the problems our governments are facing politically and economically. But this rating agencies, they provide you investors with insights into the risk associated with investing in a particular bond. They have got their mechanisms. They evaluate the risks associated with the bonds, and they give them the rating, like either the good bonds or bad bonds or very bad bonds, risky bonds or non-risky bonds. So bond ratings influence investors' confidence and demand for bonds. Of course, when you look at the ratings, when you buy something online, you basically look at the ratings of your suppliers, and that rating basically helps you decide whether you should be buying things from them or not. That similar thing happens with the bonds, that when you buy a bond, you look at the ratings of the company that is issuing that bond. So the bonds ratings influence investor confidence. A high-rated bond generally offers low yields. As you remember, the basic principles of the finance is high risk, high returns, low risk, low returns. So if your bond is credible, if the company that is issuing the bond is credible, its yields will be lower, because if you are investing in a credible company, it means that you are actually like having a safe bet. You are going to have a safe investment. So safer the investment is, the lower is the returns. Okay. And similarly, the riskier is the investment, the higher is the return. Like, say, for example, if the bond is lower rated bond, if you think about this situation in this way, that, say, for example, a similar, like one at the same time, the America and Pakistani government both issue a bond, and suppose they are actually offering a same rate of return on the bond. Like, say, for example, the return of the bond is 5%. Like, people generally will choose the American bond because of their safety, because they basically are the bonds which basically are the bonds which actually they can actually rely on, as compared to Pakistan. If you compare the economic condition of Pakistan with the economic conditions of the US, of course, the US economy is the largest economy in the world. And Pakistan's economy, of course, is not so large, and that basically makes them a less contender or less likely to have got this investments, like, to earn investments. What the Pakistan can do to attract people? The Pakistan can attract people by actually offering higher returns. So it means that the riskier is the bond, the return is the higher. Like Pakistani government cannot attract people unless it basically, like offers higher returns. So this is what something happens. So you basically, like, if the Pakistani bonds are lower rated, people will not actually invest at the same rate with the safe bonds. So that is what something happens. Similarly, the companies actually have to face this. In Pakistan, we have got some credit rating agencies that basically are very much are up to their tasks. If you visit their websites, they generally have got a very explicit kind of a ratings for different kinds of bonds. And these companies include, the first company, the PACRA is the Pakistan Credit Rating Agencies. So the Pakistan Credit Rating Agency Limited it provides, the PACRA basically provides you credit ratings and research services for various financial instruments, including bonds. Similarly, we have got GCR VIS Credit Rating. So that GCR VIS credit rating company, they basically offers credit ratings and research services for bonds and other debt securities issued by corporations and financial and government entities. So right now on your screen is the website of the VIS Credit Rating Company Limited. Now you can see here, like, that this is how they do the ratings. Like, say, for example, the first is the Adam Security Company Securities Limited, and the date of assessment is the 28th December 2023. It is an entity. Its long-term, investment is rated as A minus, and and this is the short-term is A2. The outlook is positive, and similarly, you have got AKD Securities. It is the basically, it has got different kinds of ratings. So you may basically see here that either they are stable or they are actually improving their ratings, or they are basically, having a similar kind of a rating as before, or what exactly is something happening with them over the time. Okay. Something similar, you can get on the PACRA, and they are the, the different kinds of websites that actually rate the companies between A, B, and C, and they tell you like whether they are stable or not stable. So you may actually read that websites, and you can do more research on it, and you can find out that which bonds are good bonds and which bonds are bad bonds. Okay. So further, internationally, you have got different kind of agencies that basically, rate different companies and countries. The Standard and Poor's, Moody's Investor Services, Fitch Ratings. They are very popular international rating agencies that basically provide uh, ratings for all over the world, companies and the governments as well. So factors affecting required returns on the bonds. There are factors that, say, for example, some bonds pay you higher returns, some bonds pay you lower returns, some bonds pay you very high returns, some bonds pay you very low returns. So that basically what are the factors that affect the required returns. Now, the first factor into this is the current market price. If it is already being traded at discount, the returns will be higher. Like, say, for example, as you remember that, the lower is the price in the bond of the bond market, the higher is the return that you get through the bond. Similarly, as we were discussing the example of the bonds, say, for example, if you're talking about that how this Pakistani bond can be compared with the US bond. Of course, the difference between the Pakistan bond and the US bond is the risk of default. So when Pakistan launches a bond, it has to offer a premium. It has to offer some extra money or some extra kind of amount for attracting people, towards their bonds. Okay. So this default risk premium is very important, that basically is offered. Like, say, for example, if the bond is riskier, if there is a chances of default on the bond generally offers you higher returns. Similarly, the taxability premium, like, if you look at the different kinds of investment opportunities on websites or different kinds of companies, they offer you or attract you through the taxability premium. Like, say, for example, like how much is your income taxable? Either you are going to get the tax rebate on it or not. Like, that's something are very much. So in some of the investments, when you make into companies, you get like, waivers on the taxes that you have to owe, that you owe to the government. So this is a kind of like, kind of a package that you get when you buy a bond or you make an investment somewhere. And they sometimes ask you that you are going to get the waivers of the taxable income equal to the amount of investments that you're making here. And sometimes according to some percentage of the money that you basically have invested in. So this taxability premium also affects the price of the bond. Another is the liquidity premium, how frequently you can trade the bond, how much active this bond is in the bond market. Like, say, for example, by the active we mean there are some kind of assets, some kind of cars, some kind of mobile, some kind of TVs, some kind of computers, which are sold in the market like hotcakes, and some are not. Like, say, for example, some cars, everybody is willing to buy certain cars, everybody is not willing to buy certain cars, everybody is willing to buy certain motorbikes, everybody is not willing to buy certain motorbikes. So, like, that all depends on that how liquid that particular kind of an asset is. So that basically determines, like, that if there's a, like, liquidity is higher liquidity, so you basically, I know that there's a premium basically charged. The rates of the bond or the returns on the bonds can depend on the liquidity of the bond. Okay, we have just discussed that how this liquidity affects the price of the bonds. And the maturity date, of course, like, you have studied the like, yield curves, and these yield curves tell you that how your rate of returns or interest on the bonds change when the maturity period changes. So the longer is the maturity, the higher is the return that you get. So that there are a lot of factors: the risk premium, like, current market prices, taxability premium, liquidity premium, and, like, if the bonds are less liquid, you actually will not lend money at lower rate. You will require more money, more returns on it, because you are actually getting into the asset which is not, like, which you cannot sell in the market whenever the need arises. Okay. So another factors that may affect your returns is the inflation expectations and economic conditions. So, like, if you are expecting your inflation to rise in the future, you may be like, you may want higher returns because of the erosion of your purchasing power. Because whenever the inflation increases, you basically actually you lose the like, value of your money in terms of the goods and services. Similarly, the economic conditions. So overall economic environment, including economic growth and employment levels, can influence bond yields. If there are the economies are strong, they lead to, like, higher interest rates and consequently higher bond yields, because you actually have got good opportunities there. So what are the different types of bonds that are offered in the market? Like, say, for example, technically you have got different kinds of bonds which basically are issued by different kinds of agencies. Like, say, for example, some bonds are issued by the government. Okay, so governments, because in the time of need, when they basically have got deficit in their budgets, or they want to run or want to, like, finance a different kind of a project, they go to the market and ask people to lend them money. Okay, so they issue the government bonds. Similarly, the corporations do the same thing. They also go to the market and borrow money whenever they have got deficits, or whenever they actually want to expand themselves, or they want to increase their, like, productions. There is another kind of a bond that perhaps I don't know if you have heard about this or not. The mortgage-backed securities. Some bonds, like, say, for example, are the bonds, like, as you go to the bank, sometimes you need to, like, keep some kind of mortgage or collateral, like, in front of the bank to get the money from the bank. Something similar the companies have to do sometimes, or the banks have to do sometimes when they are issuing securities. It means that they are borrowing money by issuing bonds. Now, what is the surety the people have who are buying those bonds? Like, say, for example, if I am buying a bond, if I am taking a bond of a company or a government, what kind of surety I have that I am going to get my money back? In that particular for that particular thing, the one of the major thing is that you trust in the government. Okay, so that is like unsafe kind of investments. But if you the government or the corporations basically is telling you that we have got this particular mortgages and the back of it, like say for example, if we default, we have got these assets available, and we can get give you back money by selling those assets in the market. So that kind of securities are called mortgage-backed securities. Okay, so technically they are asset-backed securities, and if the assets are mortgages, then actually they are called MBS. Otherwise, they are called ABS, asset-backed securities. So whenever the companies issue bonds and they keep some assets as collateral, like say for example, these are the assets, these are the dedicated assets. If we do not pay you back, or we don't have money to pay you back, we will be paying you back after selling those assets. That's what actually is the kind of a structure of these bonds, and they are called asset-backed securities. Similarly, the municipal bonds, like of course we don't have got very active local governments in Pakistan, but wherever you have got these local governments active, they basically have got very actively, like they issue bonds as well to finance their projects. And like say for example, in Pakistan we have got only two tiers of the government. Like we have got the central government and the provincial government. We don't have got the third tier of the government, which is called the local government. And that basically is are issued by all over the world through these local governments, actually, which they uh, issue to get money to finance their projects and to meet their expenditures. Similarly, the foreign bonds, we have talked about them, that you sometimes like to borrow from other countries. So you actually issue one particular country, issue bonds in some other country that is actually a foreign bond. Now, who participate in the bond market? The participants in the bond markets are the government, corporations, and financial institutions like banks. So majority of the places are occupied by these three agents in the bond market: the government, which issues bonds, corporations, they issue also bonds, and financial institutions like banks, insurance companies, and other kind of companies, they also involved into the bond market. They actually like either in the borrowing or lending. So if you look at this bond market world, like these government bonds are the rock stars of the financial world, financial bond markets. So government actually issues these bonds for various projects, like say, for example, for building infrastructure, funding education, or even dealing with some economic crises. So that basically are the the reasons sometimes the governments borrow money from the people. It goes to the market. It actually issues them bonds and gets the money, and that money they use to build infrastructure or fund education or deal with some economic crises. And the government bonds are considered super safe. Why are they considered super safe? Because the government is, of course, the government. Government is something, it's a bigger entity, it's a more reliable entity. The government has got the power of issuing currency notes. The government has got the power to borrow money from some other countries. The government, is a bigger government. So it's a very big entity. So that basically is super safe in terms of default, in terms of other kind of the risks. Treasury bonds and saving bonds, etc. They've issued. They do the treasury bonds. Treasury is the like something is related to the government. So the saving bonds, they also issue the saving kind of bonds. Now, if you look at the corporate bonds, these corporate bonds is a type of debt security issued by a corporation and sold to investors. They are a loan to a company. When you are when you buy a government bond, you lend to the government. When you buy a corporate bond, you lend to the corporate sector, like you just lend to the companies. And of course, these companies are riskier than the government. Okay, so corporate bonds tends to be less risky than stocks. Of course, when you are investing in a corporate sector, you may actually invest in two kinds of instruments. Either you buy bonds or you buy stocks. Stocks are the variable income securities, which are more riskier than the bonds, of course. So the corporate bonds usually have higher interest rates than government bonds. And why do you think it happens that why the corporate bonds usually have higher returns than the government bonds, kind of things? Now, if you look at I don't know, being economic students, I don't know how many of you would have heard about debentures or subordinated debentures. Uh, Debenture is just a name given to the security that is not secured by any collateral or asset and issued by corporations. Like, when you go to the bank, sometimes you buy, like, when you are taking a loan, some loans are secured loans and some loans are not secured loans. And secured loans are those loans which basically are issued after taking some collateral, and unsecured loans are the loans that basically are given on personal guarantees or personal relations. Like, say, for example, if some of your relatives, some of your friend comes to you and asks you money to, like, borrow, and you lend him or her money. Now, basically, what are you doing? Basically, you are giving an unsecured loan, and that unsecured loan is that because if he or she defaults, you don't have got anything to sell. In another instance, if you somebody comes to you, your neighbor, your friend, your family, or anybody, and they ask you for loan, and they actually gives you some kind of their assets, like, say, for example, some expensive watch, some expensive assets, some expensive bonds, some expensive something, that basically this loans become secured loans. Because, like, say, for example, if they don't pay you money, you have got certain value of an asset that you can sell, and you can basically either use yourself, and you can sell that in the market and you can recover your money. So the debentures are basically unsecured, like, they are not very secured loans, because, like, they are not secured by any collateral or asset. They represent an unsecured loan made by investors to the issuers of the debentures, and which can be a corporation or the government entity. When the government issues some bonds without any collateral or without any asset, that are also called debentures. So, in the event of default, debenture holders are paid after secured creditors, but before equity holders. Of course, like, they are very much riskier bonds, and because, of course, like, that you actually, like, when the companies default, when the companies stop functioning, they actually, like, give money according to the, like, different kinds of classes. Like, first of all, they pay to the secured loans holders, then they pay the debenture holders, and then they pay to the subordinated debenture holders. So subordinated debentures are even more riskier. Like, they are basically, like, they come in the last in the line. Basically, initially, if the company pays its dues, initially it pays to the, like, secured loans holders, then basically it pays to the debenture holders, then it pays to the subordinated debenture holders, and then it pays to the equity holders. So subordinated debentures are also known as subordinated bonds. In the event of default, subordinated debenture holders are paid only after the debts and obligations have been met. This means that they carry a higher risk. And what do they get in return for the taking that higher risk? The higher yield. So many people actually are interested in buying these bonds, subordinated debenture bonds, just because they are basically getting higher returns than secured bond. Like, say, for example, if the secured bond is offering them 5% return, they may be offering you 10% or 6% or 7%, of course, at least more than the return that you are going to get from the secured loan. So people basically may, but they actually get into the risk as well. Of course, this is again the very much advice from the finance experts. The higher risk you are willing to take, the higher return you can get. But if you are not willing to take higher risk, of course, the return can be low. So the corporate bonds have got securities, like, there are different characteristics of the bond. They are secured bonds, the mortgage bonds. The secured bonds type of the secured bond is a mortgage bonds, because in that case the mortgage bonds are backed by mortgages. Okay, and unsecured bonds are can be, like, different types of the unsecured bonds are offered in the market: debentures, subordinated debentures, variable rate bonds. So they are all very unsecured bonds without any collateral or without any assets. Now, you are aware that, like, that there are two kinds of markets exist in the financial sector: spot and future. Okay, spot transactions happen at the spot. You just do the transaction, get the things like exchanged, and just go away. But there is also a kind of a hedge market available in the financial sector that basically deals with the future. Like, say, for example, for you require uh, different foreign currency in the future. You actually want to buy a future contract. Like, say, for example, as we discussed, an example that, like, suppose you are a uh, like, a cotton grower. You want to sell the cotton that basically is still to, grow, and you actually are still like you're sowing the seeds of the cotton, and you are expecting this cotton crop to be ready by the after the 2 or 3 months, say for example, and you want somebody to buy this. Okay. Similarly, the textile firms, they basically have got seasons coming. They need have got they have a need of cotton in the future. So they may come to you and you may go to them, and you may have a future contract. Right now, the no crop exists, and neither the person who is selling the crop is having a crop to sell, and neither the person basically who is buying the crop needs that crop at that moment. But this all transaction is taking place for the future. Okay. So something similar happens in very different kinds of instances in the bond markets as well, because these generally the future markets are there to hedge you against the future risks. Like say for example, in the instance I told you, the grower of the cotton basically is saving him in the from the future uncertainty of not able to sell that cotton in the market. And similarly, the textile firm is actually saving it by actually having a contract with a cotton grower to avoid uncertainty in the future that if they require the cotton and they are not able to get the cotton, or they are not able to get the cotton at certain price which actually they are interested in. So bond futures are standardized contracts that obligate the buyer to purchase and the seller to sell the specific quantity of particular bonds for a bond index at predetermined future date, known as delivery or an agreed upon price. So similarly, if you are making a contract that in the future you will buy a bond or you will sell a bond at a certain price, at a certain quantity, so that will be a kind of a bond future market. So, like in the future, when you make a transaction, there are two kinds of arrangements that you have. As some are obligatory arrangements. Like obligatory arrangements means like if you like say for example, if I promise you that I will buy $1,000 from you after 1 month. Now, am I legally bound to buy that bonds or not? That determines either I am dealing with the futures or options. I can take option. I can take, in the case of option, I may or may not go to buy that particular dollars from you after 1 month. But in case of the promised contract, I will have to buy this. If I don't buy that, I may be sued in the law of court because of my contract with the company. So there are the two kinds of arrangements that you make in the future. One is a binding arrangement, other is a non-binding arrangement. So if your arrangement is a binding arrangement, this is called futures market, and if it is non-binding arrangement, this is called option. Perhaps you would have heard about the put options and call options. The put option is a sale option, and call option is a buying option. Okay. So the bond options are financial contracts that give the buyer and holder the right, but not the obligation. You are not obligated. You are not legally bound. You are not legally required. Of course, if you get that, you just, if you want, you can actually go into the contract. You can basically oblige them. Otherwise, you are not really technically obligated. To buy call options or to sell put options, a specified bond or bond future contracts at a predetermined price that is called a strike price on or before a specified expiration date. Okay. Another type of the bond that basically is, just of course, none of the bond wants to be a junk bond. But like as you have got some things at your homes which are valuable, and some things at your homes are not valuable. Like they are junk. Like you sell them to, like say for example, these all like these people who buy scrap, and there are some things that you sell at a high price. So something similar happens with the bonds as well. Like some of the bonds basically are, they turn into junk bonds. The junk bonds are the bonds that basically have like different kinds of credibility. They are low rated bonds. So if the bond is a very high risk and nobody wants to buy that bond, and it's a very just a very waste bond, like it's not something very valuable bond in the market, so that bonds are called junk bonds. So that is rated below triple B. If some bond is being rated below triple B, this is called junk bond. Often, trust insurance companies are not permitted to invest in junk bonds. Some institutional investors don't buy the junk bonds. But who buy those junk bonds? Okay, bond yield calculations. Like it is the perhaps the most important bit of this lecture. When you are making investments, what exactly is the objective of this course? This course's objective is to help you able to decide between different kinds of investments. You are actually being trained here to distinguish between good and bad investments. And how do you distinguish between good and bad investments? The good investments that get you good returns, the bad investments that get you bad returns, low grade investments give you low returns, high grade investments get you high returns. But for that, you should be able to exactly calculate that what kind of exact returns are you going to get from this particular kind of a bond or investments. Like say, for example, if you are making investments, you should be aware of that what exact returns are you going to get from it. Something similar happens with the bonds investments. When you make bond investments, you try to have bond yield calculations. Yield calculations means like you try to get the returns, you try to calculate the returns that you're going to get, because unless you have got good calculated returns available, you may not be able to basically decide that which bond is better than which. Okay, so bond yields are quoted using a variety of conventions depending on both the types of issues in the market. The current yield, which is called IC, is an approximation of the yield to maturity on coupon bonds. Yield to maturity means the bonds that you hold till the maturity, that what kind of returns do you get if you hold a bond till maturity, because some of the bonds you sell before ending the maturity, you just sell them into the secondary market and you get the capital gains or capital losses to actually encash your money. But in some of the instances, you hold your bond up till the maturity, and the return, actual return that you get is called the yield to maturity. So current yield is an investment's annual income divided by the current price of the security. Okay, so it's a straightforward. There is a first value. The first method of that is called the current yield. So current yield is calculated is like, is this like this. Okay, this is the formula for the current yield. Now, say for example, if you look at this example here, what is the current yield for a bond with a face value of $1,000 and a current price of $921.01 and a coupon rate of 10.9%? Okay, so you can find out two things from here. The first thing is the annual cash flows. If you are going to get 10.9% on $1,000 bond, it means that your annual cash flow is 10.95% of $1,000, and 10.95% of the $1,000 is $109.5. Just like, if you just divide this particular fraction by this value by 100 and multiply this with 1,000, you can get this 109.50. Okay, and you have to divide two because you are finding out the current yield. The current means current right now. Okay, and this current yield depends on that how much investments you have made into this, and the investments that you make into this is depending on the market price. At what price are you buying this bond? Okay, so this is the market price. So the market price is the $921.01. And if you divide that 109 with 921, roughly you get 11.89%. Okay, so I hope you get this. So the current yield is important for investors who are looking to buy and sell bonds in the secondary markets. It provides a measure of the bond's return that considers current market price. So of course, you are basically knowing that what exactly is the return right now. Now, if you think about the coupon bonds, another type of the bond that you basically are aware of are the coupon bonds. The coupon bonds are the bonds that give you monthly, quarterly, semi-annually, or annual returns. They are unlike the discount bonds. You don't get the one-time return. Like say, for example, in the case of the discount bonds, you buy a bond at less price than the face value, and when you just sell that bond back or when you get this matured, you get the face value. So the difference between the price at which you buy and the face value is the return that you get. In case of the coupon bonds, you get monthly, quarterly, or some annual, some periodic returns. So the term coupon bond refers to the bonds that pay you coupons, which are nominal percentage of the par value or a principal amount of the bond. The formula for calculation of the price of the bond is the present value calculation. We have seen this in the earlier lectures as well. So you must be aware that, like, what do you do basically? To find out the yield to maturity, you find the discount value of it. So so the value of all financial assets, including bond, is determined by the present value of the future cash flows. So what do you do? Basically, you try to basically look at that what exactly is the discounted value of the cash flows that you are going to get in the future, along with the main principal amount that you get in the end. So if you remember the formula from the earlier lectures, you may basically see, like, that this is an easy calculation. You may calculate the returns on your coupon bonds by discounting the future cash flows. Like, say, for example, the next month you are going to get $100, another next to next month you are going to get $150. And what you do basically, you just divide them with 1 plus r, the discount rate. Okay, and that discount rate is determined, like, through different ways. So investors are indifferent between having a certain amount of money today and receiving a future cash flows if it is subjected to increment of the interest rates. So we have learned about this present value calculation. So you can divide the future cash flows by the discounted discount rate. Now we have seen that, in the earlier lectures, that the bond prices fluctuate. We have also seen some of the instances or the reasons for the bonds prices to change, and that were related to the bond demand and bond supply. And we talked about the wealth, we talk about the future expectations, we talk about the future inflation, we talk about other factors that may affect the bond. So something similar we are talking about here. So why bond prices fluctuate? The prices of the bond, sometimes the bonds are being sold at discount, and sometimes the bonds are being sold at kind of gains. So they are basically, that depends on this prices fluctuates because not everyone agrees on what the future cash flows of an asset will be. So difference in expectations create the demand and supply situations. So you basically, that is what something you try to do. What are the steps to find the value of a security? You identify the cash flows resulting from owning the security, determine the discount rate, and find the present value of it. So that basically can increase or decrease the demand depending on the different kinds of considerations. So that is something like, as you know, that the people actually can increase or decrease demand by finding out the different values of the returns. So if the demand goes up, the price goes up. If the demand goes down, the price of the bonds goes down. Similarly, if the supply goes up, the price of bonds falls. If the supply goes down, the supply of bonds basically goes down. So what are the different kinds of bond trading strategies? How should you trade the bond? Like, say, for example, if you are having a bond, what kind of strategy you should choose to, earn good interest? There are different kinds of strategies for it. Like, say, for example, sometimes you follow the strategy that involves purchasing a bond with the intention to holding them until maturity. You hold the bond until maturity, you take it bond to the company, and you just get the returns, whatever the returns you are actually having, you're getting that. Another is the interest rate speculations. Sometimes you try to get, like, of course, traders who anticipate changes in the interest rates may adjust their bond holdings accordingly, because if the interest rate is going to go up, you should expect the price of your bonds are going to go down. So you may sell now. If you're expecting the interest rates to go down in the future, and now basically if your interest rate goes down, the price of the bond goes up. Okay, so you may basically, that with the speculation you can change the trading strategy. And similarly, yield curve strategies, investors can understand that how the yield is changing according to the maturity and according to the risk, and you can adjust your holdings of the bonds accordingly. Similarly, the credit quality, traders can focus on bonds with specific credit ratings or credit profiles. Sometimes they offload themselves with certain kind of credit profiles and credit rating bonds, and sometimes they unload themselves with the different kinds of bonds and credit ratings. So they keep selling. There are some swing trading as well. The swing traders aim to profit from short to medium term price swings in the bonds. Like, they are traders, they keep buying and selling the bonds. Okay. So in detail, if you want to look at, these are the explanations of it, that you may actually read them at your convenience time. That what is the strategy of buying and holding, what is the strategy of interest rate speculations, and what is the yield curve strategies, and how the credit quality focus basically changes your holdings of the assets, and how the swing tradings take place, how the people actually get the benefit from these kind of trades. So what is the best for you? This is very much an important thing. Remember that each strategy, whatever the strategy you follow, has got its own merits and demerits. If you want to be successful, you have to find your strategy, that what exactly are your tolerance level, what kind of goals do you have, how much risk you can bear, and what is the market outlook. So whether you are holding a long term, surfing interest rate waves, or dancing with the credit quality, the key is to craft a strategy that suits to you. So none of the strategy is good for everybody. That is should be crafted according to your needs.